Hi, everybody. I'm Karen Andres. I am the project director of the Retirement Savings Initiative at the Aspen Institute Financial Security Program. And I'm really excited to welcome you to today's conversation on better technology, better retirement savings, exploring the digital tools that improve user experience. This is the second event in a two-part series that the Aspen Financial Security Program and Future of Work initiatives have hosted on digitally enabled and people-centric retirement savings. So just to frame the conversation today, retirement savings matter to household financial security. They're a critical source of income after a worker leaves the workforce. They're also a critical backstop for large out-of-pocket expenses that come up, including some of the costly healthcare expenses that are uncovered by Medicare or insurance. And finally, and really importantly, retirement savings are second only to home ownership as a means of building wealth in America. So it really matters that we have a retirement savings system that works for everybody. For those who have access to it and who use it well, it does work, but it doesn't work equally well for everybody. And that's what this conversation is about today. We know we have an access gap to close. Approximately 50 million Americans don't have access to workplace retirement savings. And those are disproportionately low-income workers, women, and people of color. We also know from the Bureau of Labor Statistics that another 23 million have access but don't participate, and millions more who do participate are not saving enough. So today's conversation is important. As we seek in different ways to expand access to the system, we must also seek to improve the usage and ultimately the saver outcomes. So today we'll be focusing on customer-facing design and technology that can drive those outcomes that we all want to see. We're proud to present this event with support from and in partnership with Cognizant. And a quick reminder, we're going to be asking you to submit your questions via the Q&A function, but feel free to use the chat to reflect, share links, etc. as well. So with that, I would love to introduce our moderator and invite him to turn on his camera and his microphone. Welcome to Saurabh Bhargava, Associate Professor of Economics at Carnegie Mellon University. Saurabh has done some incredibly impactful research on decision-making in both healthcare and our retirement savings system. And you may not know this from our conversation today, but is actually one of the finest connoisseurs of pop culture that I've ever met. So welcome, Saurabh. We're so glad to have you. And I'll just go ahead and ask you to tee up the conversation because in addition to your sparkling wit and personality, obviously, we've asked you to moderate because of some of the findings that from your research on the power of design. Could you speak to those just briefly to set the stage for why this conversation matters?
Yeah, absolutely. And Karen, I appreciate the introduction, and it's a real thrill for me to participate in this panel. I think we have a diversity of perspectives represented here that's very exciting, because I think that's how we solve serious policy challenges. So to help motivate the discussion, I wanted to briefly share some takeaways from some recent research that I've done with some colleagues to investigate some of the issues that Karen teed up, and specifically the preparedness of actual 401k enrollees and the role that digital design of the enrollment interface has in shaping that level of preparedness. Now, the research involved an analysis of about 200,000 administrative accounts across several hundred 401k plans and a series, excitingly, I think, a series of randomized control trials across about 500 plans. So the work yielded three takeaways that I want to quickly touch upon, because I think they might be relevant for today. The first is that our projections of asset accumulations under a variety of plausible assumptions for current enrollees suggest that this problem of retirement insecurity or retirement poverty extends far beyond those who lack access to plans or those who simply don't participate in their 401k plan. And it extends to actual enrollees. And we estimate that 40 to 65% of current 401k enrollees in automatic enrollment plans have a non-trivial risk. So we arbitrarily define that as greater than 25% for falling below thresholds that we associate with retirement poverty or insecurity. So we were really surprised by that characterization of preparedness. So second, our field test suggests that the initial enrollment decision of a newly eligible employee in an automatic enrollment plan again, to either personalize their enrollment, to confirm automatic enrollment, or decline enrollment altogether, is surprisingly important for savings accumulation. And this has to do with the fact that default rates are typically low and matching incentives are fairly generous, but they require you to personalize your enrollment when you first are eligible. And what we find is that modest, non-informative changes in the design of the enrollment interface have a large effect on the size of these initial contributions and consequently on future financial security. And through these RCTs, we estimate that small changes to design could lead to an increase in savings and preparedness that's equivalent to raising the match by 62%, or the modal plan match. And then finally, and we'll return to this point later in the conversation, I think, we found in a survey of several hundred plan sponsors that the large majority underestimated the power of design, particularly relative to economic incentives like the plan match. And they struggled, I think as we all would, and I'll show you an example in just a second, to identify effective design elements. So on this next slide, and I promise this is the last one, I wanted to give you an example of the types of design changes that we actually tested in the field. And these are examples of the enrollment interface that a newly eligible employee would see if they visit their enrollment portal. Now, the screen on the right led to an increase in personalized enrollment of 15 to 20%. And critically, these enrollees ended up doubling their initial savings. And this led to a significant improvement in asset accumulation over time. Now, what's surprising here is that you might think that the colors or the catchy headlines on the screen to the right were responsible for delivering this improvement in engagement, but actually at least 50 to 60% of the effect, we think, is actually due to this somewhat foreboding warning language that is in the box to the left. So somewhat counterintuitive. So the takeaway here from our research is that design matters, even if it's not informative. Certainly matters more than I think economists would have recognized. That's probably not remarkable in and of itself, but it also matters, I think, more than plans may recognize, particularly relative to economic plan incentives. So with that, I want to introduce our distinguished and accomplished panel. Aspen never fails to deliver at these events, and certainly that's the case with our three panelists today. So John, Anurag, and Stephanie, I want to invite you to turn on your videos and briefly introduce yourself. And since the word of the day, apologies to John Oliver here, is technology, I was hoping that you could also share with us an app, service, or device that you've recently come across that makes you particularly excited about the future of financial tech and the future of this session. So first up, we have John Godsall, partner at McKinsey & Company and head of their North American retirement practice. So John, can you tell us a little bit about your work and if something comes to mind, your favorite fintech discovery?
Yeah, thank you, Saurabh. Thank you, Karen. It's really an honor to be here and to participate in this dialogue, to participate in this topic, one that's close to my heart. Professionally, I lead McKinsey's consulting practice in the retirement ecosystem. So what does this mean? In this capacity, I lead our thinking on what does the next generation of financial security look like. I also consult for advisors, sponsors, record keepers on topics like strategy, growth, digital transformation, innovation, operations, the kind of impact partnerships that McKinsey is involved in. To your question on technology and apps, it's funny, I was just looking at my iPhone and thinking about what apps do I use. And the three apps I use the most are the Wall Street Journal, Apple Fitness, and Airbnb. None of them are obviously financial technology apps. Airbnb, because I'm trying to figure out, hopefully post-vaccine at some point this summer, I'll go and travel like I'm sure we all hope to. But what was interesting to me about those three things, a news app, a fitness app, a travel app, is that so many elements of our broader lives are intertwined into our financial lives. All of those things either hopefully help me spend money better or encourage me to spend money. And so I think there's an interesting question about how financial services apps can better integrate into our lives more broadly and the things we care about doing in our daily lives. And I haven't yet found the perfect app for that, but I'm sure someone in Silicon Valley is inventing it. But Saurabh, really excited for the conversation. Thank you for having me on your panel.
Great, thanks, John. And I think you queued us up perfectly for the person who might create that magical app that you have in mind. And from Chicago, that is Anurag Tripathi. He's a co-founder of Manifest Ledger. Really nice guy, met him last year. So Anurag, tell us a little bit about your work. And since I know you know the space quite intimately, I'm gonna ask you to restrict yourself to one single new fintech app that's caught your eye.
Awesome. Thanks, Saurabh. Pleasure to be here and talk about technology, especially in the retirement industry. So I'm the co-founder of Manifest. We're the easiest way for people to transfer their accounts. We do that, actually, their retirement accounts. We do that through employers. It's simply a URL within welcome packets, termination packets, and behind the scenes, we're building the pipes between the 401k providers to really transform the way people transfer. It's been my third startup, second in the retirement space. I used to lead a team that designed a record-keeping system that we scaled up to 150 million of plan assets, and really fell in love with helping people save for retirement by working in Illinois with Chicago to restructure Illinois' pension liabilities. And so on the technology side, I think fintech has really been blowing up recently. Something that is near and dear to my heart, especially being in retirement, is the payroll system and the payroll, different providers out there. Finch is a company that I've been looking at really, really closely. They're a payroll API company, similar to what Plaid does on the account aggregation side. Finch makes payroll data accessible to other people to hopefully build out those apps that John was talking about and really build that ecosystem around money and data.
Anurag, thank you so much. You're doing such important work, and we're going to get back to that later in the conversation. So next up, we have Stephanie Wan, who's a partner at Idea Couture. So Stephanie, can you give us some insight into the fascinating work that you guys are doing at IC and a digital tool that's recently caught your attention?
Sounds good. Hi, everyone. Stephanie Wan here. Thank you for having me here today. I'm excited to be here to participate in the panel as well. I'll start with a bit of context. So Idea Couture is a human-centered design firm. And so what we do is really build next generation experiences through contextual human insight and understanding of how that meets with broader market shifts. We're actually part of Cognizant, which is a technology organization. So together, the way that we like to think about what we can do is essentially we can both dream it and build it, just to give you sort of an idea of that. The kinds of problems that we tackle can range. So, we can be looking at what healthy aging means to people, and then what does that maybe mean to a food and beverage company, all the way down to how do you design a portal for a plan sponsor when you think about the importance of their role in helping people plan for the future. So it just sort of shows you again the spectrum of the kind of work that we can do. So the purpose for me being part of this panel today is I'm going to bring more of that human-centered design angle to the conversation. So you'll probably see that as I talk through this. I guess the digital tool that's caught my eye. It's funny because I think when we, the panelists, were connecting last week, this was something we actually ended up talking about. But the current conversation around NFTs, so the non-fungible tokens, has been something that I think is very intriguing. I won't profess to be an expert in this. My bad way of trying to explain this to everyone in the audience is that it's a one-of-a-kind kind of virtual asset. It's very unique, and so it can't be replaced by anything else, and it's protected by blockchain. So the application that we see today in other industries is for artists like painters or musicians who traditionally haven't been able to really have their work monetarily recognized in the way that it really should. And so the latest headline, I think, on this one was, there was an EDM artist, his name is Blau, and he's actually sold the first ever tokenized album for like $4 million. And while this may seem somewhat disparate, it's showing how technology and emerging technologies are coming together that may have an impact and show new opportunities for areas like the retirement space. So that's the idea that I think might be interesting to bring into the conversation.
Stephanie, this is fantastic. I wish I could invite you to every future academic conference that I attend on savings. You'd add so much. Yeah, exciting stuff going on in the NFT space. I think Jack Dorsey is selling his first tweet, and the bid is currently at like $2.5 million. All right, well, the clock is ticking, so I want to dive into the conversation. So I wanted to start off by getting us a handle on fairly complex retirement ecosystem, particularly as it pertains to employer-sponsored plans and the defined contribution space. And we'll also think about how this ecosystem can help to understand some of the challenges faced by potential enrollees. So John, I wanted to start with you. To the uninitiated, it might seem as if administering workplace retirement plans is more complicated than mining Bitcoin, with the array of plan sponsors, record keepers, advisors, banks, insurers, regulatory bodies. Would love for you, a couple things that I'd love to hear from you. First, could you give us a quick primer on the DC supply chain and flag the various stakeholders that you think are most important for generating these user experiences? And finally, if you could you give us your quick assessment as to the specific challenges that those stakeholders face in delivering quality experiences?
Yeah, sure, happy to. And certainly we could spend all day on any one group. So I'll try and keep it high level. And then if you want to go deeper into a particular area, I'm happy to go there. But I think your point about this takes a village, this is highly complex, is absolutely true. If I were to describe it without that introduction, I would have said complex, fragmented, and probably most importantly, misaligned incentives. And I'll explain what I mean in a second. So there's 4 broad groups of stakeholders in the value chain, and within that, there's subgroups, if you will. But in the first group, you have the service or product buyer, the client, if you will. This is the sponsor and or participant. The participant being an employee, the sponsor being the employer. What this group of folks is looking for is frankly, they're looking for retirement outcomes. They want to see better outcomes. Certainly the employees, the participants want the best outcomes for themselves in terms of saving for retirement, but often they face daily financial strains, which make that a difficulty. In some cases, the sponsor and the employer, despite the fact that they do want the best possible retirement outcomes for their employees, are motivated by cost. So you have this sort of duality of, yes, we want the best outcomes, but we want to do it at the lowest possible cost. So that's the buyer of the services. Next, you have the intermediary landscape. This is highly fragmented. You have retirement plan consultants, you have financial advisors that do retirement plans, sometimes referred to as 2-plan Tonys, but people that are effectively broking retirement plans for the small and medium stakeholder group. And then you have a growing landscape of what are called TPAs, or third-party administrators, that help sort of grease the wheels in getting retirement plans set up. Now, what this group is solving for is reliability, consistency, nothing really going wrong. What they're usually looking for is the right technology capabilities, the right experience in this space, services, operations. But what they don't want is they don't want a call from their client, the sponsor, saying that something went wrong. They're not incentivized by retirement plan outcomes per se. So they're really looking for the bigger and the more reliable players in this space to offer the product. The third group is the product manufacturer, right? This is the record keeper or the asset manager. Asset managers deliver sort of the IO product, the actual asset management product. The record keepers are providing the administrative services so that that the plans can be administered. What they're doing primarily, it's pretty obvious, but they're trying to deliver the best service at the lowest cost. And in so doing, again, certainly they want more in retirement savings. So they want higher participation rates, higher participation amounts, but they are not incentivized directly on retirement plan outcomes, individuals who meet their retirement goals. And then finally, you have this ecosystem of providers that surround the retirement space. Think of a benefit administrator or a benefit provider like a group life insurer or an enrollment company. And what they're solving for is experience, quality, service, creating a really good experience for that participant. So there's a lot of players in the mix. Yeah. Everyone's taking a little bit of the economics from that individual participant for the services they're providing. Simply, no one is incentivized on this broader concept of retirement security or retirement outcomes. It's a nice to have, but not a need to have economically. And what's interesting about that, the reason I draw that out is if you were to ask any one of these groups, if you were to ask the advisors that are administering the plan, if you were to ask the record keepers themselves, if you were to ask the sponsors, so the CHRO of a company, what they would tell you is, hey, what I'm trying to do is create the best environment for my employees or these individuals to reach their goals. So everyone's aligned in terms of values and mission. What we don't see in the ecosystem or the value chain is alignment on incentives to that mission, which I think is part of why we're here today.
John, that's fantastic. I really appreciate the structural insight into the market dynamics. And we're going to return back to some of the structural impediments to good user experiences and efficient design a bit later in the conversation, because I think that's going to come up again and again, this idea of misaligned incentives and cost pressures. So I want to turn, Stephanie, to you and bring you in on this topic. I know that when I think of user experiences in retirement, I think of it very, very narrowly, as those slides might have alluded to. At Idea Couture, you've helped a lot of different kinds of companies reimagine user engagement through a much more expansive lens of human-centered design. So can you tell us what that implies for user engagement in financial services and talk about the distinction between user experience and service design?
Happy to. I think it starts with understanding that experience lives at different levels. So to the point that you were just making, when we think about user experience at its narrowest definition, we're talking about layout, language, colors, the number of clicks, right, that makes up a digital touch point. But when we take a step back and we look at it from a service orientation, and I think this is what John was actually hitting on, is that it's about holistic understanding of needs of all of the actors within an ecosystem. And that's regardless of channel. So whether you're talking about digital, eventually if it's in person, how that works with call center, what does that mean from a digital touch point through social media? And I think when you look at it from the retirement industry perspective, we can be solving the problem of understanding how to create that better portal, right? And what does that user experience design look like? Or we can be taking that step back and understanding how the needs of people and the different players with this ecosystem have changed over time, and whether or not the model that exists today actually responds to those needs in the right way. And I think part of what John was mentioning is that the incentives aren't necessarily there for people to look at the higher order problem. And I would say that that is very true, and especially when you look at it from a needs perspective, because that's likely part of the challenge with the overall system.
Great, yeah. And so John's really alluded to some of the structural challenges in achieving that more expansive view of engagement in financial services. Mm-hmm. Are there other specific obstacles in financial services in achieving that kind of human-centric design that has to do with, the psychology of financial decision-making? Can be anxiety-provoking, and there's potentially scope for mistrust.
Yeah, I think there's two pieces to this. So one on the maybe on the structural side, to maybe say what John's saying in a different way, you're looking at a systems problem where it requires all players within that ecosystem to be able to align on what that needs to look like in the future. On the more people-centered sort of side of this, going back to what you were alluding to around trust, when you think about the kinds of financial decisions that people need to make along the way, the orientation of the model today doesn't necessarily address every single type of person that exists within, the American public. So the model of how financial advice is sort of looked at is through the lens of, are you mass affluent? Are you ultra high net worth? Are you high net worth? And that's not necessarily, who the 45 million that don't have access to a plan actually is representing.
Right.
So the question becomes, what is the opportunity for all of these players in the ecosystem to start acknowledging that other group of individuals who have a different sort of set of needs and different sort of contextual drivers in their life that need help in being able to make the right kinds of financial decisions along the way, because they will be very different than somebody who is more of that mass affluent, ultra high net worth category.
Okay, great. I mean, the complexity is not only structural, but it extends to the type of consumers involved. So Anurag, I want to bring you in here and perhaps narrow the scope a bit. I think that you're heroically tackling one of the real impediments to asset accumulation, and that's the loss that's associated in savings anytime you transition from job to job. BLS suggests that the typical worker will have 12 jobs over the course of a lifetime. So how significant a drag on accumulation are these job transfers? And can you give us some insight into why it occurs?
Yeah, definitely. I think one of the reasons why I got involved in the retirement space was because of this complex structure, and it really created a lot of opportunity to provide a service that aligns incentives a little bit more. I guess to tackle this problem of people switching jobs, we started by examining participants and really understanding their behaviors throughout their life cycle. And really early on, that meant partnering up with Washington University to do a little bit of a bigger study and understand what happens when a participant switches jobs. And it turns out there are three options. Cashing out is one of them. You lose 50% of your account balance. Surprisingly, extremely common, especially for smaller account balances. Post-termination, alternatively, you can just leave the account as is. We're based out of Chicago, and a lot of even the MBA students here end up doing that, taking that option. Older accounts have higher fees. It's hard to manage multiple accounts versus just one retirement account. And then alternatively, there's transferring, and that's something that's super difficult today. 89% of people who start that transfer process don't finish it. And so really making that process easier, focusing on reducing that friction involved in that process is something that we've been working on doing from day one. And it turns out through that study with WashU that we're able to increase average account balances within a plan. We're able to also increase contribution rates for typically very difficult to target demographics like minorities, women, younger demographics. And finally, we were able to reduce cash outs as well. I think the paper will be published sometime next month, potentially. But we're able to through making the transfer process easier, it's led to sort of maximizing retirement outcomes, which also translates on a plan-wide level to employers, but also to providers who make money based off of assets under management. They love to see those higher account balances there.
Yeah, Anurag, the degree of friction here is really remarkable. How far away are we from transitioning to a regime where everyone has a consolidated account and portability is no longer a problem?
I think it's a process. I mean, we're just getting started. It's been a year and a half since we started this process. We're the first employer-to-employer transfer tool in the marketplace today. Yeah, and I think that there are some regulatory pushes to make this happen. However, I think to balance the two, I think at the heart of it, it's an extremely complex process. And technology will definitely play a role in making that process easier. And we found by making it a 10-minute journey versus a 60-day process, it leads to maximizing retirement outcomes for participants. And we'll see over time how that translates into all the stakeholders and the industry as a whole so far.
Great, terrific. So I wanted to transition into our second topic, which involves the discussion of the power of good design to encourage employee savings and to explore, I think we've already touched upon some of these issues, some of the challenges that impede the adoption of good design. And John, I thought maybe we'd start with you. In the research that I alluded to earlier, we showed that on a very narrow margin of the digital user experience, modest changes in design led to surprisingly large, what we think, shifts in behavior. But the question is, in this market, given the structural factors that you described earlier, is the market set up structurally in such a way that market competition will naturally lead to the emergence of good design that facilitates savings? And if not, what do we do? Do we need regulatory oversight, or do we need some other type of third-party intervention?
Yeah, the answer part I'm not so sure about, but I do think that when you think about the root cause of, let's say, not great design, because I think we can think of the right way to say that. There's a couple things going on. One is that a lot of the providers in this space, the asset managers and the record keepers, have this fiduciary responsibility and this sort of regulatory landscape that they're attempting to navigate. So the disclosures, fee disclosures, the product disclosures, all of that seems to come before the outcomes, which creates a complicated picture for a participant who's trying to make the best decision in the name of their family and their family's financial security. So I think what I'm not calling for is less regulatory oversight, but maybe in terms of the disclosures or what's put forth on a record keeper's platform, there's got to be a way to simplify it, and there's got to be a way to enable that. I think the second big thing is that we are reaching an inflection point between product and design in terms of what is the biggest driver of outcomes. So if you take a slightly longer time period, if you look back over the past 30 years, what we'll see is that product expense ratios have come down enormously, driven by firms like Vanguard, BlackRock, T. Rowe Price. All these firms have come down on the actual product, the target date fund product pricing. And that's actually been really good for participants who have kept their money in the DC ecosystem, because you're getting great product at a low price. Actually, a lot of that product today, the target date funds that you can get, again, these are obviously the big providers, the Vanguards, the Fidelities, the BlackRocks of the world. There actually isn't much more room to go lower, right? They're at a really, really low fee ratio on some of these S&P 500 target date funds. And so what that means is that now the next inflection point, the next, we call it S curve, but the next element of growth is going to come from design, because you say, okay, well, we got the product pretty well priced. So now let's figure out, how do we get better outcomes by helping people on these client journeys that enable them to have better outcomes. So I think there is, yes, certainly sort of a regulatory component to it. But I do think, to your question on sort of market incentives or competitive incentives, there's an element of these firms are beginning to say, okay, the next wave of competition is going to be in the realm of design, whereas the last wave was in sort of the product realm.
Yeah, no, that's interesting. And so you alluded to some of the fiduciary responsibilities of record keepers with respect to disclosures and certainly kind of the economic structure of plans. Do we need an expansion of those notions of fiduciary duty to cover something like design? I mean, it sounds like you're suggesting that we don't, and market competition might naturally lead to the emergence of quality design. But it does strike me as surprising that we have so much oversight on something like disclosures and economic plan structure when I think design really does matter in terms of shaping behavior.
Look, I'll be curious what my fellow panelists say. I mean, I think that's going to be a tough putt, right? I mean, in other countries, we see this. So if you look at sort of Australia or countries in Europe, they do actually have kind of a more central view on what good design looks like and oversight of it, and they're creating better experiences. I think at least what I'm seeing in the US landscape at the moment is that this battlefield of competition in design is only emerging. And one of the reasons that it's been slow in the record keeping space is just these are very low margin businesses, as you all know. And so to have that capital to invest in an incredible UX on behalf of the participant, many of the firms don't have it, but I personally, what I'm seeing is that this is an emerging battlefield. So I think the free market forces will push us in the right direction.
Terrific. Stephanie, let me bring you in on this. So there are a lot of disclosures in the financial service space. And I think it's an open question of how many people are reading the fine print before they're opening up the Robinhood app and trading options. Can you give us some insight into how firms, perhaps in other domains or certain sectors of the financial service space, are able to successfully communicate risk in ways that are both effective and help to build rather than destroy trust?
Yeah, so this would be a problem I think we're seeing across different kinds of industries. So you see it obviously in healthcare when it comes to sort of like the cautionary labels. You see it in insurance and banking when it comes to some of the T's and C's that people don't necessarily look into. And this goes back to, I think, the conversation that you were bringing in earlier around trust, because what a lot of companies are trying to do is build transparency in order for us to return to some of that trust in larger institutions. And when you look at some of the insurtechs, the fintechs coming up, it's no longer the primary value proposition. It's become part of the package. So even when you look at, their websites and how they put their statements together, everything is much more simplified. There's a lot more white space. The language is supposed to be cleaner and clearer. And I think this is just in response to the conversation that's happening in the public around this need for not only that level of transparency, but translation. And that's, I think, one of the key things that a lot of organizations sort of struggle with is how do you explain things that are as complex, what we're seeing today and what kind of decisions people need to make and the implications of those decisions in a very simple way that allow them to move forward in terms of their what their plan might look like or how they bring their whole financial wellness to the table. So I think that it's really banking on that transparency piece and the translation that needs to come with it.
Okay, so I think that nicely transitions us to our next topic, and I think we're running a little bit behind, so I'll ask all of you if you want to weigh in briefly. We've discussed some of the promise of technology and design and some of the challenges to help improve engagement and financial outcomes. I'd be remiss, since we're only a few months away from 2020, not to ask about the potential risks associated with this technology. The illustrative and rather dramatic recent example of the promise and perils of technology, I think, maybe is best exemplified by Robinhood. They'll claim that they've positioned themselves to democratize access to markets and lucrative financial instruments. Critics will argue that it's an ideal example of how firms can strategically leverage attractive interfaces and almost gamified design elements to encourage dangerous levels of over trading. I do personally use it all the time. As full disclosure, it's actually quite a bit of fun. So Anurag, let me turn to you, or and the rest of you, please feel free to jump in. You've leveraged your power of engineering for good. What's to stop a less scrupulous version of yourself to use it in a way that potentially disadvantages the end user?
Yeah, totally. I think one of the first projects that I worked on when we started Manifest was actually with TSP accounts. And I think that they're like a really good example of this. TSP accounts are actually structured very, very well. Therefore, active duty military personnel to save within a very good structure. And what would happen is a lot of times after these personnel would retire, these registered financial advisors would be waiting in the wings, trying to steal a bunch of these accounts and put it into sort of higher fee IRA accounts. And we saw a lot of that happen. and the goal was to change that behavior and actually make sure that stuff doesn't happen. And I can speak about Manifest specifically. We don't always encourage a participant to transfer their accounts, and that's something that we built into our software. But I think this is where technology is a little bit, it can be a little bit weaker. Regulation is an area that I think, especially when it comes to taking advantage of people, or ends up like causing major issues with financial account, with sort of balances. Department of Labor fiduciary rule just passed, had an effect on rollovers and advice given to participants in that process. And I think that's something that's really important, that can really protect people's savings.
And Anurag, real quickly, are those guardrails currently in place, or do we need more and stronger?
I think like everybody that's in retirement starts by studying laws, ERISA, generally. The books are so big when it comes to like the amount of regulations within the 401k space for employers, for participants, for providers. And I would say that there are a lot of laws. Generally, I focused on studying them when starting my previous retirement startup. And I think what is more interesting to me, especially as we move forward, is how we can change the current systems, expand the pots from like things that you can't do to like make things more accessible, cheaper, faster to people. And technology, in my experience, is something that expands that pot. Regulations don't always do that.
Okay, so pro technology, I think that's where we're likely headed. I wanted to raise this final topic, final question for all of you, and it's a bit of an existential question about the future of retirement savings and the role of technology in achieving that future. So in some sense, we've outlined the ways in which technology can be used, as well as superior design, can be used to increase engagement and help employees make informed decisions about contributions and their investment allocations. The alternative, I think, that we should consider, and I'm curious to get your thoughts on it, might involve a shift towards more passive regimes that rely more on automated mechanisms, such as automatic enrollment, but auto escalation as well, to really get up, to accelerate the savings trajectory. Technology could also be used, potentially to personalize or algorithmically target default rates or auto escalation trajectories. And so I'm curious, given the objective of securing long-term financial futures, should we deploy technology to facilitate more choice and more personalized choice? Or are we better served using technology to absolve people from the burdens of choice? Anyone can jump in, but John, do you want to?
Oh man, tough question. So I kind of believe in both, and I realize that's a unhelpful answer in a sense. But auto enroll, auto escalate are critical, and we've seen this work in other countries, right? In Australia would be an obvious example, but we see it in other countries where putting some guardrails around the requirements of retirement savings is a really important thing to help get better outcomes. And we should continue to push in that direction. And I think we will see further examples of that in the next few years, would be my expectation. But certainly I'm a believer in the fact that that technology, I mean, these are not asset management businesses. These are not insurance businesses. These are technology businesses. Record keepers, the providers of record keeping services, even the intermediaries in the enrollment, they're technology businesses. And I think if you take a technology mindset, I mean, I'm loving hearing from Anurag in terms of how he thinks about building these kinds of businesses. I think if we thought about building record keeping businesses ground up as technology companies, it would really help us create better interfaces, better experiences, and ultimately, I think that'll get better outcomes. So in my view, it's a little bit of both. I'd love to see both.
Okay.
The
Stephanie,
one caution,
yeah.
the one caution I would add is when we build technology, sometimes what's inherent in that are some of our own biases and assumptions, right? So
Right.
the idea of like auto enroll or auto escalate, that assumes that we understand the context of how people are making those decisions, and that therefore we can then do it for them. And I think what we're seeing is that, people are smarter, they're savvier, and in some cases they want to know more about the choices that they're making. And so it's about, instead of forcing people to, get to a place where we think it's best, it might also be about looking at solutions that help allow them to understand where they want to go and make those choices, because the context of their lives is very different. The point in time when people are having those key moments in their life, like when they get married, when they are retiring, all of those things are shifting and changing. So we have to just be aware of the fact that we're baking some of those assumptions and biases into the technology that we're building, and that might be taking away people's empowerment to make choices for themselves based on their context.
Okay, no, I think that's an important countervailing perspective. Anurag, do you want to jump in here?
I think Stephanie technically summarized it really, really well. A lot of these decisions in finance are technically subjective. They're philosophical. They're not always black and white. Some of them are easier than others, but a lot of times that balance with extra context sometimes gets lost when we default things. I love defaults. Being in University of Chicago, and I've read some of the literature on that stuff, and especially when it comes to growing savings, it makes a lot of sense. But specifically when it comes to transferring, in our case, there are more complex things that come up. Taxes, a Roth conversion, for example, is one of those scenarios. And that's a lot of information and context necessary to be able to make that decision, or even like for an individual, but also to help out with that sort of process. And so I think as many times as possible, defaults are helpful, but that choice and that optionality, when the person knows what they're doing or has access to an actual financial advisor, tax professional, lawyer in that situation, really helps to make sure they are taking care of their own money. At the end of the day, it's their money. They worked hard for it. They can end up making those decisions if they actually want to.
Well, let me ask you a quick yes or no question. I think I've been watching too many congressional hearings. Would you guys be on board with revising the discrimination rules and safe harbor provisions to encourage every plan to not have a default rate of 3% for automatic enrollment plans, but to go up to 6 or 7% and to automatically enroll everyone into auto escalation up to some higher cap?
So I guess in my previous startup, we actually worked with, I guess this is a yes or no question, but a little bit of context. I worked with small businesses. We signed up a bunch of them to actually start 401k plans. Sorry, what was that, Saurabh?
I'm sorry, go ahead.
Yeah, and the size of employer matters, I guess, when it comes to like that bigger employer, University of Chicago, since I mentioned Chicago already. There's a different demographic than potentially that mom and pop pizza shop that's offering a 401k for the first time ever. And plan design helps to get participants to contribute quite a bit, and auto enrollment helps with that. But I think it matters on the firm, and I think HR and plan sponsors have a big role to play in that dynamic.
Okay, should we shift to some Q&A? I think there's a long list of questions here from the audience. So let me. Okay, so here's one. Stephanie, this might be one where you can jump in, but others feel free. How do we think about designing interfaces and experiences for the different needs of customers? You talked about there being such a diversity in that space. And can you talk more specifically about what the opportunity for customization might look like?
Yeah, so I think when it comes to designing interfaces, there is the simple functional needs that people have, right? So how do I process through this plan faster, right? When you think about it from a plan administration standpoint, that might be a functional need that a workflow and a platform can help you with. I think the other piece to this is when you think about it from a needs perspective, what is it that they are actually trying to do? Beyond the functional, there may be other kinds of insights that they need access to in order to help understand the context of the employees that they have in their workforce and the kinds of, again, needs that they have that then inform the decisions that a plan administrator might be making about what kinds of aspects they're pulling together for that plan. Right. So it's going beyond that functional and starting to understand beyond how to address some of those needs that might not be just about efficiency and time.
Right. Yeah. Efficiency and time. You're totally right on that. It resonates. I think a question probably for John or Anurag. What might be the impact of open MEPs on design and these questions around adoption of new technological advancements and the pace of innovation, et cetera? John, do you want to take a stab at that?
Look, I think it's going to be great. I think the open map landscape is going to make it so that we are, firstly, they're going to have to create, the plan design is going to have to be much more thoughtful about a diversity of employee and I think to what Anurag was talking about a minute ago, which is this kind of contextual environment. Like if you're designing a plan for a small architectural firm and it's got specific outcomes, and this is in the small end of the space, you have very tailored outcomes focused on a tailored set of participants, often the more senior employees. I think what the open MEP construct is going to enable and allow is design thinking. And when I say design thinking, I know there's a question earlier. I'm not talking about product design. I'm not talking about like the target date fund. I'm talking about like the actual CX, UX, digital experience for a participant. I think the open MEP concept is going to force more thoughtful design from what is the experience from the moment that an employee joins a particular firm to when they're actually onboarded onto this system, to when they actually make decisions about their retirement outcomes or their retirement savings objectives. To me, this is going to create a whole exciting new kind of area of design. So for, I think it's gonna do a lot on that front.
Okay, great. John, do you see us in the future moving more sharply away from employer-sponsored provision of plans?
Yeah, a little. I mean, sharply away. I mean, it's starting from a low base, but absolutely I do. I think this state-sponsored retirement plan construct is going to become more prevalent. I think the open multi-employer plan is going to become more prevalent. I do see that, and not only do I see it, I think it's going to be probably at the whole a better thing for financial security, particularly for those in more flexible, I mean, it's an overused term. I know it's not exactly specific to what we're talking about, but as the rise of the gig economy grows and people are not only jumping jobs, but in less permanent jobs, not only are they jumping 12 jobs, maybe in a month they do 12 separate jobs. I do think we're going to see much more people employed in that kind of construct, and we're going to see this growth of the SSRP and the MEP environment. And I think that's going to be a better thing, particularly for the middle class and younger workers.
Okay, terrific. So we're down to our last few minutes, and I wanted to give each of you a chance to weigh in with some final thoughts. Stephanie, do you want to start us off?
Sure. I mean, I think this is probably going to reiterate my point earlier. Because this is a systems level problem, I think where the opportunity lies is bringing all of the ecosystem players together to think about how to build this from scratch, right? I know that sounds daunting, but it's not that, you have to start there. But if you could, forget the system as it exists today and think about it from a needs orientation of all the different players in the ecosystem, then you're now starting to shed some of the boundaries that are coming into the way that you're thinking about it, because you're so ingrained in this is how it's been set up and this is the way that we operate it. Because right now, a lot of the solutions are more about a process improvement, if you will, than they are about really innovating it.
Okay, great. Anurag, do you want to jump in? What do you have thoughts on the future of how are we going to achieve better design and on all these
Yeah,
projects?
I think we're at a really exciting time in the record keeping space and the 401k industry as a whole. A lot of them are innovating pretty at a rate that we haven't seen historically. For example, their sidecar savings, a lot of ideas that have actually conversations that Aspen has had around different ways to get people to save more, contribute more within a retirement account. And I think that it's super interesting to see what record keepers are doing. Different players with employers also are taking on as far as wellness tools. And I think the participant will really benefit from that over the next few years.
Okay. John, I know you've thought a lot about the dynamics of the ecosystem and how they're trending. Can you give us some final thoughts?
Well, I mean, amusingly, this panel construct is what I think is so exciting about the space and gives me hope. I mean, the fact that you've got human-centered design, Stephanie and Adia Couture, and then you've got Anurag actually building a startup in this space is where this is all going to come from. So I think that's what the industry needs. It needs innovation and startups thinking differently about what clients need. And then it needs human-centered design to bring it all together in a way that works. So personally, and then of course it needs academia to tell us what's in the right interest of society. So Rob, you're doing that. So thank you. So at some level, what's interesting about the construct for this panel that Karen and the team put together is that this is actually what the industry needs to take the next step forward. And so for me, I kind of get excited about that.
Great. Well, you know, John, I echo the excitement. I think it's such a thrill to hear multidisciplinary perspectives on a question that certainly in economics I think about far too narrowly. And you know, things like orphan accounts and leakage are just dismissed as irrational puzzles, I think, by many of us, and that really negates the complexity at play here, both on the decision making and the personal side, but also in terms of just the extreme complexity on the structural side in terms of the value chain. Karen, we're almost out of time here. Can I bring you back in? And panelists, thank you so much. I think we probably needed another couple of hours to really dive into a lot of these topics, but really a privilege to share the table with you, and thank you so much.
I'll just add my thanks to our panelists and also to you, Saurabh, for moderating us and taking us through this really fascinating discussion. I would also note that we had many people submit questions. We had a long list of questions. I would encourage you to reach out if you didn't get your question answered, to reach out directly to our panelists, who I know are eager to continue this conversation. This feels to me like the down payment on a much larger and longer conversation. Also makes me deeply wish we could be together in person, but there is hope on the horizon for that. In the meantime, until such a day as we can get together in person over a glass of wine and talk about these issues and meet the people who can make it happen, we'd love to invite you to register for 2 upcoming events that are relevant to today's discussion. One is, and I believe we put these in the chat with links for you to go ahead and register if you're interested. One is a book talk with Dorothy Brown. Many of you, if you've been involved in our leadership forum on retirement savings, may have met her, but she is publishing a book called The Whiteness of Wealth, How the Tax System Impoverishes Black Americans and How We Can Fix It. Super relevant to retirement savings, super relevant to how we can use policy levers to close the racial wealth gap. And then additionally, on April 15th, we will be publicly kicking off our Aspen Leadership Forum on retirement savings, where we're going to talk about why retirement savings need to be part of an equitable recovery. We're really looking forward to this set of important public dialogue, so we'd love to see you there. Thank you, Saurabh. Thank you to our panelists, and please have a terrific day. Thank you so much.